Verizon Communications, stock ticker VC, is currently trading at $33.88. The stock has dropped 15% year to date, underperforming the S&P 500, which has seen almost a 20% increase. The company's multi-year underperformance is due to concerns about increasing debt and the cost of transitioning to 5G infrastructure. During the week here, you can see the stock was actually shut down quite a lot, and that is because a Wall Street Journal investigation came out that revealed potential health and environmental risk associated with lead-sheeted cables used by AT&T and Verizon in the past, which could potentially lead to some significant legal implications. The stock has made it back up again after those news broke out, but still, is it an attractive level at the current time? That is what we want to investigate in this video. So if we take a look at the dividend history, you can see here, if we zoom out a little bit, that has actually been growing quite significantly over a lot of years. Consecutive years of dividend growth 18 and consecutive years of dividend payments 22 years. And the dividend is quite used, sitting above 7%, but is it safe? That is what we're going to take a look at in this video, and also take a look at the intrinsic value of VC. If we jump into our stock screen, you can see here that I have completely redesigned it a bit, and I have put in a lot of other metrics that I will use towards the end of the video to actually calculate a better margin of safety on a much more fact-based ground rather than just eyeballing it basically. So what we have here is, first we've punched in the stock ticker VC, and that let everything auto-populate. You can see here the current price being 33 as we said before. Earnings per share is around 5, it's great. The 5-year EPS growth is around 9%. You can also see here the PE non-GAAP 4 ratio is 7, which is compared to the 5-year average actually around 40% below. The revenue is quite slow growing, 0.74% revenue 5-year CAGR, 52-week high of 46 and a 52-week low of $31. The debt is quite high and the net debt to EBITDA ratio is above 3, so you can see that is also one of the major concerns about it. It actually has a quite good return on equity sitting around 23% and actually an okay-ish return on invested capital sitting around 8. The margins are pretty good, I would say. Actually, you do have the operating margin sitting around 23%, which is a bit above the 5-year average. And you can also see the growth over the 5-year CAGR is actually 1.6%, so also looking pretty good. The price to earning and other ratios are looking really good as well. And look at this, price to sales around 1, which is insane. The analyst target price is around 43, and the analyst target growth for the next couple of years is minus 0.73. It has actually quite low short interest, which is also really nice to see, and always good to see that it isn't a massively shorted company. The dividend yield is around 7.7% at the current time. They do have a very healthy payout ratio below 60%. The dividend growth rate over the last 3 and 5 years is 1.8 and 1.9, so not a lot of growth. Jumping into the next tab here, you can see if we zoom in a little bit, is a little bit of the dividend data, and what we want to see here is some nice steadiness and continuity in the dividend payment. So you can see the dividend growth rate sits around these 2%, so it is indeed a very slow grower. The dividend growth rate over the last 10 years is 2.3, and as we also saw with the dividend growth rate for 3 and 5 years, it's around that level. Coming down here to the dividend yield here, you can see here, if you look on the right, the dividend yield for the last 5 years sits around these, the standard mean is around these 4.8, I would say around here, but look at this coming up into the area above the line where it could potentially indicate a undervalue. And actually, if we look at the graph on the left, it actually says 34% at the current time. But let's jump into a different model to see whether or not it actually is a good bargain at the current time. So what we first have here is a discounted cash flow model, where we do take the free cash flow from the different years. We then average those growth rates together to get an applied growth rate. I've used a conservative 7%. We use that growth rate to project the future free cash flows, where we can then discount back to a present value using a discount rate of, let's say, 9% in this case. Using the cash equivalent and the total debt with the shares outstanding, we arrive at a fair value of $24 per share for Verizon. Next up is a dividend discount model, where we have the dividend payout from the different years. We then calculate a growth rate from those years. We can then calculate the applied growth rate into the future, combine that with a weighted average cost of capital, which I've chosen to be 6 for the weighted average cost of capital, and the growth rate is around 2, gives an intrinsic value of $66. Next up is the multiples valuation, where we do take some comparable companies to Verizon. We then use those PEs from those companies to get a median PE of the competitors. Using the EPS from Verizon, we get an average stock price of $99. I think that's a bit on the high side, maybe also pretty skewed by, for example, Tesla having 26 and also BCE having around 20. Jumping into the price to earnings variation model, we do take a PE ratio from the different years. We then just use the last 5 years to get a PE ratio average. Using the EPS from the last 12 months, we arrive at an intrinsic value of $51. Next up is the Graham's revised variation model, where we do take the EPS of Verizon, PE of a notable company, the future growth rate from Verizon, the average yield of AAA corporate bonds, and the current yield of AAA corporate bonds. Combining all those together using the formula here on the left, we arrive at an intrinsic value of $30. Jumping into the next one, the free cash flow variation model. So similar to the price to earnings variation, where we do take the price to free cash flow ratio from the different years. We then use the last 5 years to calculate an average. Using the free cash flow per share, we arrive at an intrinsic value of $33 per share. Next one up is the Peter Lynch model, where we do take the growth rate, the dividend yield, and the PE ratio from Verizon. Combine all those together, we also arrive at $33. Before we jump into the summary, thank you so much for watching, and if you haven't done so already, please subscribe to the channel. Leave a comment down below in the comments if you did like the new stock screener tool, and let's jump into the summary. And as you can see here, we do have all the variation methods as we have before. I did exclude the one here with multiples simply because I thought it was way too high, about 99. I think it was very unreliable PE ratio compared to Verizon, so I excluded that one. In that case, we arrive at an average intrinsic value of $39. With the current price being $33, it could indicate an average current discount of 15%. And also introducing the new margin of safety table we have over here on the left. Sorry, on the right. So what it takes is, for example, some of the metrics that I've gone through in this stock screener here. So let's, for example, say the net debt to EBITDA. Then it actually gives a score based on that. In this case, because the net debt to EBITDA is above 3, it actually proposes to put a higher margin of safety. In this case, it's a +5. So it starts at 25%. Then based on the metric, it either deducts or doesn't do anything, or it adds a little bit of margin of safety. And in this case, for the EPS growth, because it was quite good, we have deducted 10. But for example, for the net debt to EBITDA, because it was so high, it actually added 5. So combining all these together, we arrive at a margin of safety of 20. So we can put that over here, giving a margin of safety of, say, 20%, as we calculate on the right. It gives an acceptable buy price of $31. With the payout ratio being as it is, I think the dividend is fairly safe, and I also think it has a pretty stable business in Verizon. The valuation is indeed extremely attractive of the small multiples and the ratios and the 1x sales, for example. I think there is some room for the total returns to bounce back. But again, I think also there is some major concerns with the high debt they have. It is a very cost intensive business they are in. So it's up to one out there, you specifically, to do your own due diligence to see whether or not you actually feel that the debt or the other issues with Verizon is what tips it to either a buy or a hold or a sell at the current time. Thank you so much for watching, and I'll be seeing you in the next video.